This is a review of quiz 4, which was a bit of a challenge for the group. Our first question, one of several reasons that companies choose to issue bonds is to shift their capital structure from more equity ownership to more debt borrowing. An issuance of bonds would accomplish that, so that's a true statement. The maturity date is the final date on which repayment of the bond interest is due. The maturity date is the date in which the principal of the bond balance is due. So that's a false statement. Interest payments do not necessarily coincide with maturity dates. The third question, when interest rates rise, bond refunding becomes quite popular. That's a false statement. In fact, as interest rates would decline, you'd bring on more popularity in bond financing. And the next question did ask that. As interest rates decline, bond refunding should become more common. Well, refunding of bonds would be more common in a declining interest rate environment. Many companies tried to maintain investment grade status due to the significant yield differential when rated with a junk bond status, and that is a true statement. You would want to, it's much more preferable to be considered investment grade than it is to be considered junk grade. A low bond rating during economic times means that the company will have to issue new bonds at a higher rate. That's true. The lower rated you are as a credit, the higher your costs will be, and therefore a new issuance of bonds would be at higher rates than if you had had a better credit rating. The coupon rate of the bond varies indirectly with changes in market interest rates. That's not true. The coupon rate on the bond stays the same throughout the life of the bond. Markets change, and we therefore would value bonds based on market rates or yield to maturity. It's the payment or the coupon that does not change on the bond. A call feature allows the corporation to redeem the bond before the maturity date. Some issue bonds without call features that would not allow bonds to be brought in or called before maturity date. If you issue bonds with a call feature, then you would have the opportunity to redeem the bond before the maturity date. The call provision on some bonds allows the corporation to redeem the bonds earlier than maturity, but usually for a premium over the par value. That's a true statement. Typically, when you call a bond in, it's well in advance of the final maturity date. Therefore, you have to pay bondholders somewhat of a premium because they no longer have an opportunity to earn interest throughout the entire life of the bond because you're calling it. Therefore, calls tend to occur at a premium. Which company is a leader in rating bonds? And we're given Goldman Sachs, Bloomberg, Value Line, and Moody's Investor Services, and the correct answer is Moody's. Goldman Sachs is an investment bank, not a bond rating agency. Bloomberg is a financial news service and media company, and Value Line is an investment research company. The higher the bond rating, the lower the interest rate on the bond. You're given other choices here. The higher the bond rating, the higher the call premium. The higher the bond rating, the lower the call premium. The higher the bond rating, the higher the interest rate on the bond. The true statement here is that the higher the bond rating, the lower the interest rate on a bond. The higher bond rating means your company has a higher credit quality and is regarded as a safer issuer. Therefore, you're going to get lower rates or favorable interest rates on your bond issue. A AA2 bond is rated lower than a AA1 bond rating. This question got to our need to understand the scheme that Moody's and Standard & Poor's uses in rating bonds, and a AA1 would be favorable to a AA2 bond rating. Our 13th question here. Bond refunding typically occurs when interest rates in the market are sufficiently less than the coupon rate on the old bond. You would want that to happen. That means that your cost of borrowing now is significantly less than your cost of borrowing at the time you had the initial issuance of the bond. This is the same reason why we might refinance our homes, because interest rates are sufficiently less than what we're currently paying. The 14th question, which of the following are the advantages of leasing? In fact, all answers here were true. It's an advantage that we may be, there may be no down payment requirement as in a purchase. A lease obligation may be substantially less restrictive than the provisions of a bank borrowing or bond indenture. And a lease option would help us avoid the negative effects of obsolescence because we can get out of the lease. As a result, you have less risk of whatever equipment you're leasing becoming obsolete. The benefits of debt to the corporation include all of the following except, well, debt is a fixed obligation. Debt generally is a lower overall cost of capital than is equity to the company. Debt does have tax-deductible interest payments. What debt does not do is it does not increase the stock value of your company when debt is heavily used in your capital structure. An investment banker acts as a middleman between a corporation needing funds and investors with funds. That's a true statement. The investment bank has entire portfolios of customers that they have had experience with, and those customers of the investment banker would listen to the investment banker, take their guidance very seriously and their suggestions very seriously on buying your stock issue or your bond issue. So they are middlemen between corporations and companies that and investors that have funds. In 2008, history shows that this was one of the worst environments for companies wishing to go public. And that's very true. In 2008, the stock market saw a decline of some 40 to 50%, creating an environment where investors did not have an interest in stocks in general or IPOs specifically. The next question has to do with the Glass-Steagall Act. We have this statement that the Glass-Steagall Act of the 1930s was created to separate U.S. banks, commercial and investment sections, which is true, which later, because it gave an advantage to U.S. banks because foreign banks were affected by having them combined. That's not true. Foreign banks did not work under Glass-Steagall restrictions. The U.S. did work under Glass-Steagall restrictions. Only a small amount of security issues are sold on a best efforts basis. That's a true statement. It means you go to the investment banker. The investment banker doesn't give you a 100% guarantee that they're going to underwrite your entire issue. They do commit to making their best effort at placing the issue with investors, or their best effort at buying a balance of stock issuance that's not been successfully placed. So it's a best efforts basis that's most common. Next question. One of the purposes of an underwriting syndicate is to distribute securities to the public. That's true. An underwriting syndicate is simply a grouping of investment banks rather than one investment bank. For instance, Goldman Sachs might join up with Merrill Lynch and might join up with Bear Stearns, and this would or Citibank. This would be then a syndicate of banks that would help get your securities distributed and placed to public investors. When stock is exchanged on the New York Stock Exchange, and it's considered a secondary offering, when stock is exchanged during an initial public offering, that is considered a primary offering. And that is true. IPOs represent primary offerings. Stocks that are bought and sold on the New York Stock Exchange are secondary transactions. IPOs generally underperform compared to the general market in the immediate aftermarket. That's a false statement. IPOs tend to outperform the general market. This comes about because in order to market an initial public offering, the investment banks, which are underwriting the offering, maybe on a best efforts basis, want to underprice the security a bit, making it more attractive to get the security successfully launched. As a result, there's an opportunity if you buy IPO shares that you might see an immediate positive bump in share value. The primary rationale for repealing the Glass-Steagall Act was that the US Congress recognized that international competitive disadvantages existed for US commercial and investment banks. That is a true statement and the rationale for repealing Glass-Steagall. The best efforts method of underwriting is the most common method used in issuance. That's a true statement. The Glass-Steagall Act prohibited commercial banks from combining investment banking and commercial banking functions. Primarily what we were doing here is preventing the commercial bank where businesses and individuals make deposits, sheltering them from the risk taken on by investment banking activities, and that's what Glass-Steagall did. When investment bankers are in the function of underwriters, acting as underwriters, they give a firm commitment to purchase the securities from the corporation at a set price. So the firm commitment can be on a best efforts basis or it can be on a guarantee, most often best efforts. The risk function of investment banking is categorized mainly under their underwriting function, represents the largest risk that the investment banker is taking. Dilution of earnings occurs because a new issue of common stock creates more shares outstanding, so you split the wealth of the company into more pieces. This often will reduce earnings per share, perhaps temporarily. That's what dilution is. We have Maxwell Corp comes to market, a new offering of 450,000 shares at 22 bucks. Maxwell will receive $19 per share. The firm has 1 million shares outstanding and earnings of $6 million before recording the issue. What is the amount of earnings per share after the stock issuance? We do the math, we come to $4.14. Which of the following is considered an advantage of going public? The advantage is that we have increased liquidity for the corporation's shareholders. The items that did not meet the criteria of being an advantage here is that ownership is more controlled by the company. That's not true. Increasing the amount of shares authorized to sell, that's not an advantage. The president becomes more of a public relations person. That's not favorable for a company. So the increased liquidity is the appropriate answer. Our final question, which of the following characteristics are not an advantage of being a publicly traded company? And something that's not an advantage is that you're going to have compliance costs around public disclosure. You have to file quarterly reports, you have to file annual reports, have an annual audit done, and other sorts of requirements. When you are public, have your internal controls tested. As a result, that is not an advantage of being a publicly traded company. That then would conclude our discussion of